Deciding to buy a home can be really stressful. It's one of the biggest purchases we make. And if you've never done it before, you're not going to know where to start. So let me walk you through how to get approved for a home loan. I'm going to cover what to look out for and what information you're going to need. This is going to help you reduce some of that stress and some of that uncertainty in the process. So let's jump into it. Hey, what's up guys? I'm Ben Sun. Welcome to my channel. If you've been here before, welcome back. If this is your first time, welcome for the first time. I don't just talk about how to avoid getting rejected for a mortgage. I also talk about things like personal finance, investing, and real estate. So if you're into that kind of thing, hit that big red subscribe button. So the first and most obvious step is to reach out to a lender or a couple different lenders. I won't go into a ton of detail about that in this video because I did make another video on how to shop for lenders right up there. But generally the best practice is to talk to your friends and family, talk to your realtor, or work with a local bank or credit union that you already have a relationship with. If you don't have a relationship with a bank or credit union yet, identify a couple that you might want to talk to or start building a relationship with because they can offer some discounts that maybe a traditional mortgage lender can't. Again, I won't go into a ton of detail on how to figure that out, but that would be your first step, is to identify at least 3, preferably 5 different lenders, because you can actually save money by shopping lenders. But at least identify 3 that you want to talk to and open a conversation with. All right, so let's assume that you have your 3 lenders picked out. You can generally do this on their website, but I usually recommend that you do it in person or on the phone. Most of it can be done on the phone, but you're going to want to call each one of them and ask if you can do a pre-qualification or a pre-approval. Now, with a pre-qualification or a pre-approval, what they're going to do is they're going to take a little bit of your basic information, which I'll talk about in just a second, and they're going to pull your credit, and they're going to see, based on that information that you gave, what you can get qualified for. They usually don't collect any of your income or asset documents at this stage. They usually base it off stated income and stated assets. And if you're honest about that, then the pre-qualification or the pre-approval will stand once you actually get ready to purchase a home. So it's critical that you have these numbers. Again, I'll go through them in just a second, but it's critical that you have them on hand so you can be as accurate as possible. Because if you just guess, you could end up getting an accepted offer on a home and then have the numbers change and getting your deal declined, which doesn't make anyone happy, right? Then you'll have to try to find a new house based on new numbers. And guys, honestly, this happens a lot. So let's talk about what exactly you're gonna need and what you can look out for so you can be more prepared when you're having this conversation with a lender. So the basic information that they're gonna ask for, and you're gonna wanna have this handy for anyone that wants to be on the mortgage. And that's going to be your name, obviously, your date of birth, your social security number. They're going to ask you for a 2-year residence history and whether you rent or own those properties. If you own other properties, this would now be the time to disclose it. And if you do own other properties, they're going to ask you how much you pay for the mortgage, property taxes and insurance, those types of things. And then they're going to ask for a 2-year employment history. This is where it gets really tricky. So you have to have at least 2 years of employment unless you are a student. If you're a business owner or a 1099 self-employed person, so a independent contractor, then you have to have been on that job or having owned that business for 2 consecutive years. And if you've had any big gaps in your employment in the last 2 years, even if you've had a 2-year total history, you're gonna wanna talk to your lender about that at this time so that if there's any issues that they might have or any issues with you getting approved, they're gonna wanna know about those ahead of time, because that's one of the biggest reasons people don't get approved is by inconsistent employment. And 2 major pieces of getting pre-approved for a mortgage are gonna be your credit score. You're gonna wanna plan on at least having a 600 credit score. This is gonna give you the best opportunity to get approved. Some lenders will allow you to do under 600, so they'll go down to 580 or 560. But as a general rule, you're gonna need at least 600. I would shoot for higher than that though. If you could do 620, 640, that's going to give you better interest rates and more options. And so if you're under 600 credit score, I would take some extra time and try to work on building your credit. Again, this is going to give you more options and it's going to give you a better interest rate, which is going to save you thousands of dollars over the life of that loan. So it might be worth it to delay the conversations with your lender for a little while in order to build your credit score higher. Now, the other major factor is your debt to income ratio. This is how much of your income is going towards debt each month. A lender is generally only going to be able to approve you for 45% of your income going towards debt, including the mortgage payment that you have now. Again, this is kind of getting in the weeds a little bit, but if you know this number ahead of time, you're going to know what to expect, and you might improve your chances of getting pre-approved for a home or getting pre-approved for more home if you are able to pay off some of your smaller debts ahead of time. Again, you don't have to do that, but you can do this calculation by yourself. I'll walk you through it in just a second. But you can do this calculation by yourself, and that's going to give you a good idea of what you're going to get pre-qualified for. So let's go into an example. Let's say you make $5,000 a month before you pay taxes, and you have $1,000 a month in debt. So like credit cards, car loans, student loans, things that report on your credit report. This doesn't include rent. This doesn't include utility bills or car insurance or anything like that. You would have a debt to income ratio of 20%. That means that you could have another 25% set aside for a mortgage. So on your $5,000 a month income, you could get pre-qualified for a $1,250 per month mortgage, or it'd be a $225,000 mortgage. So you can run this number yourself. You can take your pre-tax income, divide it by 0.45, and that's going to give you how much of your income can go towards that total. So you can get a copy of your credit report and see what all is reporting on there each month. Again, link in the description below for where you can pull free credit reports. And then that's going to tell you how much of a mortgage payment that you can get. And you can just go to a mortgage calculator. Again, I'll link to Bankrate's mortgage calculator down below. And you can just literally play around with like, okay, $225,000 mortgage is X amount, or $300,000 is X amount. And you just run that against how much you make every month. And that's going to give you a good idea of what to look out for when you're getting pre-qualified for a lender. Now, if that number isn't what you like, you could look at some of the smaller debts that you have, pay those down, and that's going to give you a better foot forward with your lender to be able to get pre-qualified for more. And one of the advantages of knowing this 45% rule is that your lender, every time you talk to them about a pre-qualification, they're going to want to pull your credit. And you don't want too many people pulling your credit because that can actually drop your score over a certain period of time. Again, it kind of depends on who else is pulling your score. But if you have 3 to 5 different lenders all pulling your score, that could impact your credit score. So if you know the 45% and that's not a number that you like, or it is a number that you like, then you can grant them permission to pull their credit and run an actual pre-qualification. Now, once you're pre-qualified, what do? Well, the lender is going to give you a letter called a pre-qualification or a pre-approval letter. This is the letter that you can hand a seller or a realtor to actually make an offer on a home. And once you have an accepted offer on a home, you'll sign a purchase agreement, you'll present that to your lender, and you'll start an actual application process. This is where they give you your actual interest rate. Interest rates change every day. So if you got pre-qualified a month ago, the rate's going to be different on the pre-qual than what your application is actually going to have. It shouldn't change that much, but once you actually get an application started, you can talk about locking your rate. This is also where they're going to order an appraisal, they're going to order your title work, they're going to ask for all of your information, so your W-2s, your 2 months bank statements, your most recent pay stubs, and they're going to ask you where your down payment's coming from. Although you don't need to put the money down right now, that would be at closing. You have to prove to them where your money's coming from ahead of time. And so they're going to ask for like bank statements, or if you're getting a gift, or if you plan to use a down payment assistance program. One of those they're going to want to know ahead of time. And again, you can talk to your lender if you're planning on using a down payment assistance program. They're going to be able to walk you through how to get that. But at the time of application is when you're actually going to have to prove where those funds are coming from. And as a general rule, it takes about 25 to 30 days to close your loan from the time that you sign the application. So the lender is going to have you sign an actual mortgage application. and then it takes about 30 days from the time that you sign to actually get to the closing table. So I know it can be kind of exciting and stressful at times, but just keep in mind that it's going to take about a month from the time that you actually sign their application. So you're going to find a home, you're going to want to get in right away, but you still have that month timeline. This will give you a little bit of time to save up some more money, make some plans, some moving plans, give notice to any landlords, you know, all that kind of stuff. This is also the time where you don't want to make any other big decisions. You don't want to go out and buy a car. You don't want to go out and take any new debt. You don't want to quit your job. Yes, that happens. A lot of people quit their job actually during the mortgage process. Don't make any big changes that would impact your credit or your income, or that could get your loan denied immediately. If you want any additional information about down payment assistance programs, first-time homebuyer programs, or a specific mortgage type, check out my mortgage playlist right up there. And if you have any questions, comment down below. And if you got value out of this video, guys, it really helps if you please hit that big red subscribe button, and we'll see you on the next one.